Apple, the tech giant from California, has been one of the best performing stocks over the last 5 years, the last 10 years and the last 40 years. Ever since April 2005, Apple's stock has increased by more than 10,000%, creating enormous wealth for its long-term shareholders. Today, Apple is one of the most iconic and influential technology companies in the world. And from its humble beginnings in a garage to its current status as a household name, Apple's journey is truly remarkable. And with innovative products like the iPod, iPhone, iPad, iWatch, Airpods, and all sorts of services, Apple has changed the way we listen to music, communicate with each other, and access information. So in today's video, we will take a closer look at the 3 underlying components of the success story of Apple stock, so that investors can understand what they have to look out for when trying to make successful, possibly life-changing investments. So without further ado, let's uncover the secrets to Apple stock's incredible success. Alright, hey there, my name is René Zellman, and as we already outlined in the introduction, the success of Apple's stock has been truly remarkable. And so it should come as no surprise that in 2016, Apple's impressive business performance caught the attention of legendary investor Warren Buffett, who decided to invest in the company himself. Over time, Warren Buffett acquired 895 million Apple shares, representing 5.6% of the outstanding Apple stock. And as a result of Apple's success, these shares are now worth $123 billion and make up 42% of Buffett's total equity portfolio. In total, the stake cost Buffett $33 billion, netting him a gain of 267% as of today, making it his best investment ever in absolute terms. Now, the aim of this video is not to discuss Buffett's Apple investment specifically, but rather to understand what has driven the spectacular long-term performance of Apple's stock. We will take a closer look at the period between 2006 and 2022, a 16-year period during which the stock's value increased by 5,818%, a compounded return of 29% annually, making Apple one of the best performing stocks in the world over this 16-year period. If you invested $10,000 at the beginning of this period and then added another $5,000 each year, you would have ended up with a net worth of $2.4 million. Now, obviously, there are many qualitative factors that one needs to consider when trying to evaluate the true source of this long-term success. And of course, Apple also faced and overcame a lot of setbacks and difficulties on its way to becoming one of the biggest companies in the world. One qualitative factor that comes to mind here when analyzing the fascinating story of Apple's rise to the top is their obsessive focus on not only satisfying but actually delighting their customers, which ultimately also allows them to charge the premium prices that they are known for. One of the best investors of all time that you might have never heard about, Nick Sleep, he has actually recently released a public letter after years of silence in which he highlighted exactly this idea. The idea that for long-term business success, customer obsession is key. Let me just quote a short passage from that letter. It seems to Zach and me that for most companies to thrive over the long term, one constituency must be looked after before all others, and contrary to what some on Wall Street or in Westminster may suggest. That constituency is the customer. We reason that if a firm's relationships with its customers is profitable and enduring, then that will provide the cash flow to pay a decent salary to its employees, a fair price to suppliers, a dividend to shareholders, the tax people can have their take, and crucially, still leaving something to reinvest in new and better products. A self-reinforcing virtuous spiral can be established. The sketch below, penned by Jeff Bezos in the 1990s, and his model for Amazon, illustrates how better products lead to happy customers, lead to more cash flow, to better products, to more customers, and so on, with all parties enjoying and benefiting from a growing ecosystem of win-win relationships. It's hard to do and takes patience and a certain orientation and discipline, but when it works, it's a beautiful and very profitable model. Now, obviously, Amazon's business success relies much more on sharing scale benefits with customers in the form of low prices than Apple's success. But both companies share this obsessive focus on their customers. Now, the main focus of this video should actually be on quantitative factors that are easier to measure. And if we put on these quantitative glasses, we can identify 3 sources that have contributed to the 5,818% return over the 16-year period between 2006 and 2022 that we referenced earlier. The first factor is probably the most obvious one. Apple was able to tremendously increase its revenues and earnings. For this video, I will focus on Apple's operating income. Back in 2006, Apple generated an operating income of around $2.6 billion and was then able to steadily increase its earnings power, leading all the way up to an operating income of an incredible $119 billion in 2022, 16 years later. This alone already contributes to an increase of 48x of the stock price. Now, what's worth highlighting here is that some of that return can be attributed to an increase in revenue. Back in 2006, Apple's revenue was $19 billion, and today it stands at a whopping $394 billion. However, this only represents an increase of 19x, so a significant part of the increase in operating income actually stems from margin expansion and operating leverage, a concept that I think every investor needs to be aware of. When a company has high operating leverage, it means that a relatively small change in revenue can result in much larger changes in operating income. This is because fixed costs such as rent and salaries do not vary with changes in production or sales volume. So how did Apple specifically achieve its margin expansion? Back in 2006, Apple's operating margin stood at just 12%. Today, operating income represents more than 30% of revenue. Well, I think Apple has achieved this margin expansion through a variety of strategies. First, by releasing newer and more advanced products and strengthening the Apple ecosystem, Apple was able to charge higher prices for these products. Secondly, Apple has worked to reduce its costs by streamlining its supply chain, vertically integrating many of its production steps and negotiating better deals with suppliers. And thirdly, offering a wider range of products increased Apple's overall profitability, like for instance its services division, which includes advertising, Apple Care, its cloud services or its payment solutions, generated much higher margins than the core products business. Okay, let's move on to the second source of shareholders' total return, because that is the expansion or contraction of valuation multiples. Multiple expansion refers to the increase in the valuation multiple, such as a popular one would be the price to earnings ratio, aka the PE ratio. But as we just looked at the operating income of Apple, we need to look at a valuation multiple that focuses on this metric as well. So what we will consider here is the enterprise value to EBIT ratio, and we can see that the valuation multiple assigned to Apple by the public market has actually declined over this 16-year period from around 25 to around 20. So if Apple wouldn't have been able to increase its earnings power and earnings would have stayed flat, investors would have actually seen a loss over this 16-year period because the multiple contraction was actually a headwind. And then the last source of return that investors need to be aware of is the impact of share buybacks. A share buyback essentially refers to the concept that a company repurchases its own outstanding shares. This reduces the number of shares outstanding, which will increase the earnings on a per share basis, leading to a higher per share stock price. Share buybacks can be an indication that a company's management believes its stock is undervalued, and they can also be used to return value to shareholders. Now, over the years, especially ever since 2012, Apple has spent billions on these repurchases, which ultimately led to a decline of the total share count from around 26.5 billion in 2012 to around 16 billion in 2022. This share reduction alone generated a compound return of 2.6% annually for shareholders, increasing the value of the stock by a factor of 1.5x. And if you now take all of these 3 factors into consideration, so the increase in earnings, the decline in Apple's valuation multiple, and the reduction of shares outstanding, you arrive at the total shareholder return of 29% compounded annually, which I have shown you in the stock chart earlier. Interestingly, Apple's actual total shareholder return is even better than that, once you factor in that Apple also started paying a dividend to shareholders back in 2012. Now, to learn more about a company's dividend policies and why investors should actually best avoid companies that pay a dividend, I think you should watch the following video next. Take care.